Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is Friday, December the 27th. Just thought I'd jump in here today and film a few little open areas on some of the real estate news that's going on a couple days. Again, it's a little quiet, this time of year is to be expected, but some things I do want to speak about. Put your volume up, please. I'm outside today, and it was beautiful. Before I sat down to record, and as I sat up here, the wind picked up, and it got a little cloudy, which means we might be getting a rainstorm coming in. But you know what? It's too nice to go inside, and I'm out here right now. So put your volume up. Sorry for any background interference that's going on right now. I'll try to speak as loud as I possibly can. Okay, number one, I guess you could say, news of the past few days was the new home sales. I want to qualify this here. New home sales statistics are very difficult to follow, and the reason being because there's always adjustments going on after the fact. So of course we'll hear that, hey, new home sales are great, and then guess what? Next month gets, or previous month gets revised. So it's the Census Bureau puts out a new residential sales report, and it shows that sales rose only 1.3% in November due to a seasonally adjusted rate of 719,000 units, but it's a revision mirage. And last month the report showed 733 sales, but the Census Department revised October down to 710,000 units. So basically, when we see gains, it sounds good, but guess what? If the previous month gets revised downwards, then the month over month, doesn't look that great. So again, missing expectations because of some of the adjustments that were out there. That's what's going on these days in the new home sales area. Again, it's just difficult to figure out and track. My issue I have with that, not my issue, but just issues people out there, is that we've got home builder sentiment that's soared to a 20-year high, but home sales slipped. It is the time of year when this could possibly drop down, and the issue though is that more problematically, median home price soared 7.2%, so to 330,000, the highest since April, which means low-cost housing is not coming to the market anytime soon. So we actually had, I think the previous month showed the fact that we had the average price was, median price was 310,000. This has gone up about 20K minimum. So that's not good news for home buyers who are looking to see prices, normalize, stabilize, even come down a bit here. And just as to tag into that, 21% of new homes sold in October cost more than $500,000, up 19% from the prior month. So we can see that affordability remains an issue. People are jumping a little higher in the price points now for new homes, whether it's a function of that's all they can get, and that's why they got to jump on it, or there's some great deals going on. Who knows? But the whole point though is that, again, affordability remains an issue, especially now with prices rising for the median price of the new home. And the amount of new homes coming on the market is just not enough to satisfy the inventory issues that we are facing in the housing market. So just keep that in mind, as I said, and realize that new home sales really only make up about 10 to 15% on any given month of the overall real estate sales. So it's not like this is making a huge impact in the overall market, but 10 to 15% still can be substantial, but we're not seeing any sort of headway there from the affordability sense of things. Okay, that's that piece of information. I'll put this here so the papers don't blow away. Housing joins the everything bubble. Now it's kind of funny because I read a lot about bubbles and I like to understand them and how they work, and I think that's a whole other theory that we can discuss in a future video on how people react to bubbles and how it certainly can mislead you and cause future problems. But this is Auto Zero Hedge here. It says when people tick off the components of an everything bubble, they usually omit the U.S. housing market for a couple of reasons. So first, bubbles don't normally recur immediately in the same asset class. So if there's bubbles going here and going there, they're not always at the same time. And also memories of the past carnage need to fade before investors can be seduced back into irrational optimism, which is interesting. Second, the action in housing has been more gradual than in the 2000s, so it hasn't generated a lot of breathless headlines about speculators making killings with other people's money. That's the scoop there. But the expansion has gone on for such a long time that even the modest annual price gains have taken home prices back into bubble territory, and now in the news is starting to reflect it. Here's some links that are out there, some news headlines. Southern Cal home prices surged 5.6% to record in November. Oakland home values surged 261% in 20 years. Broward, real estate leads rebound in decades after downturn. San Diego, median home price hits all-time high. Phoenix, home price is still up, outpacing wage growth. Dallas, Fort Worth, median home price is unaffordable for the average wage earners. An average wage worker can't afford a median price home in the Denver area. Median home prices are unaffordable in the majority of the U.S. Blue state voters feel harshest squeeze from soaring home prices. Millennials have no place to turn, rising home prices. Housing shortage hits new record lows, igniting prices. That's just a snapshot of recent headlines that show that we're into bubble territory. There's no doubt about it right now. There's no denying it. People will still say, well, everyone has jobs. Well, you know what? Jobs are great. Wage is different than jobs, all right? And that's what we have to talk about. So to recap, home prices are above the 2007 bubble peak in many places, while wages of potential home buyers have barely risen, which is squeezing ever larger numbers of people out of the market, which I have to agree with. Yet somehow our buying continues. This may not qualify as a buying mania, but it's definitely looking somewhat dysfunctional because where can a sector go from a record low affordability? Well, guess what? If it wants to keep rising, if the economy and the Fed and all the people involved in real estate want to keep prices rising, one of two things has to happen. And this is what I find really interesting about this article, which I totally agree with here, is that either buyers go on strike as they and their mortgage lenders recognize that houses are a bad deal at current prices, and mortgages written at those prices are unlikely to be paid off, which means, so think about that, what was just said there. It's a bad deal at current prices, and mortgages written at those prices are unlikely to be paid off. Well, to me, that would mean that people are taking large mortgages out, all right, and with large mortgages, will coincide with lower down payments at the top of the market, which means we don't see more equity being built, which means, if anything, it'll be price reductions, which puts those loans in a risk territory, which means they're not going to be paid off, or we don't see another 10-20% increase to build equity to sell and take and pay off the mortgage and move on. So that's the problem with buying at a peak, is you got nowhere to go but down. And this is a great statement here. So I'm glad it's written. I'm glad people are realizing this. And number two, the government tries to keep the party going for as long by lowering interest rates to make future mortgages easier to manage. So again, we talk about, when we see articles saying, oh, well, everything's more affordable now. Well, it's not more affordable because prices went down. It's more affordable because the rate went down half a point, or whatever those numbers are. So it's your buying purchase power as opposed to the actual price of the home, which we've discussed many times. And the funny thing is, and we talk about this as well too with the GDP. So since a dramatic slowdown in the housing market would take the rest of the normal GDP down with it, that will of course be seen as unacceptable in the economy, leading calls for lower rates, a weaker dollar, and various other kinds of stimulus like tax cuts paid for with bigger deficits. So put it another way, even if housing doesn't crash, the need to keep prices elevated is one more impetus for what looks like a tidal wave of monetary ease coming our way. So great article here, great perspective, and that's exactly what I've been talking about for the past year plus, and how I feel is that the economy, the powers that be that run the economy are keeping this on life support. They're allowing people to purchase at the top of the market, taking bigger mortgages, lower down payments. There's no place to go but down. It's risky at best, and there's a whole other subsection of philosophy and thoughts as to where this is going to head with people in the future, which we'll get into in the very near future as well. Which turns us into this next article called "Here Are the 50 U.S. Housing Markets Already Turning Ugly." I've talked about this before a few months ago, and as a matter of fact, if you go to housingbubble2.com, you can download a report I've created which highlights the 50 worst housing markets in America. Now this just came out a couple weeks ago, so I don't know as of yet, because I haven't gone through all the 50 compared to the last list, whether these 50 have been revised. So I'm going to do that later this weekend, and if that's the case, I'll update that download that I've got for you guys to reflect this new information here. But The really issue is that you got plunging mortgage rates. Cracks are already starting to appear in many metro areas across the country, as a more profound slowdown could be imminent. And this is where because we've seen that with respect to values, Case-Shiller, accelerating or accelerating deceleration. So the slowdown in appreciation is happening right now. Now, this is interesting. Last week, Home Depot ruined the party and pretty much declared that a housing boom in 2020 is non-existent. If you look at a lot of the articles out there, you've got Fannie Mae and Freddie Mac and other groups, CoreLogic, saying, 2020 is going to be a boom for housing. Well, these are people, or this is analysis that comes through that shows what's really going on in the world. So the home improvement chain Home Depot cut its sales forecast for 2020, signaling that the real estate and consumers could exhibit weakness in the year ahead, which I do believe is true. The disappointing 2020 forecast comes amid a report that the 50 housing markets across the country are already showing signs of a downturn. So again, this is GoBankingRates.com. They evaluated 500 markets across the country, and this is interesting because this is how they evaluated the markets to make that top 50 housing markets turning ugly list, which I think is pretty good. They look for metro areas with high rates of foreclosure, underwater mortgages, variations in median home listing prices, the number of days homes stay on the market, and the percentage of for sale listings with price cuts against the national average, and determine the 50 most at-risk metro areas that are already turning down. So there's a 50. I'm not going to go through all 50. I'll just go through the top 10. And what I'll do is, as I mentioned, I will actually repost this this in my download if it's a revised from the last set of, I guess you could say, information here. So hang on a sec here. I'm going to go to the top 10. This is the 10 worst, going from 10 to number 1. Hampton, Virginia; Aurora, Illinois; Bridgeport, Connecticut; Norfolk, Virginia; Miami Beach, Florida; Baltimore, Maryland; Columbus, Georgia; Portsmouth, Virginia; Lakewood, New Jersey; and Peoria, Illinois. All right. So again, if I go to the other 40, there's a lot of Florida locations in there. Some in Texas. Some of the and sort of the Northeast. Alabama, Delaware. We got lots of Florida here. A couple in California. So it's a little bit all over the place. Bakersfield, Texas, Connecticut. So there's certain concentrations where we expect this to happen. Maryland, Illinois, Alabama. So again, a lot of these are in Florida. So there you go. You want to invest, come to Florida. I'll help you do that right away. So anyway, this is just interesting that my whole point though is that we're talking about this as opposed to last housing crisis when we weren't talking about these issues. The issues are here now. So keep that in mind. Now, kind of moving on with the same theme here, when you've got issues with local economies and cities and towns that are having a hard time, well, the retail apocalypse isn't over. More store closures expected in 2020. So far, more than 9,300 retail department stores have shut their doors this year. As 2020 comes quickly, more are expecting the retail apocalypse to drag on. Not a good thing here. And again, basically, as the retail apocalypse stretches out over the next year or two, we're likely to witness more closures from across the industry. And this is happening in shopping malls and strip malls, stuff like that. So, for me, this just shows how our economy or the way we purchase products and do business is changing. A lot of people probably have already thought in their mind Amazon, and how Amazon is changing the way we buy things. E-commerce has made life easier. Literally yesterday, I bought something off Amazon, and I was actually looking at if you look at Amazon, they have Whole Foods, and people we've all gone to maybe a Whole Foods location. I didn't realize that Whole Foods can deliver, and if I look at it, it says Whole Foods will deliver your products within 2 hours if you're a Prime customer. But oh my gosh, I'm going to try that out to see if that actually works. There may be other criteria that I'm going to find out as I drill down to do that. But just the whole point, though, is that you can see how the world is changing. So for me, what does this mean with all these retail closings? There's a trickle-down effect. And so when you see store closings at that volume, and again, 2018 had a whack of store closings as well, too. So this just, again, increases the situation. So you have store closings, which to me means loss of jobs, which means unemployment. And then if those people get jobs, maybe they're getting jobs at less wages, etc. So always the pay counts of unemployment don't necessarily reflect what's going on in the true economy, which means people will have financial issues. Store closings mean losing jobs, meaning I've got to find a new job, I'm stressing financially, I'm not going to have enough money, which could mean I'm not paying rent, I'm having a hard time paying rent, and maybe I'm not paying my mortgage, which will lead to evictions and foreclosures. So that's my point. So where are these stores? If 9,300 stores have closed this year, and more will happen in the next year, where are these people going? Where are they finding jobs? How are they making ends meet? So that's the economy. So for me, this trickles down to a housing issue. So we got to keep that in mind. And having said that, I found out today, looking at some news, that the average millennial has a subprime credit score. So believe it or not, as millennials rage, I guess it's a thing now, raging against the older generations, right? Okay, boomer type of discussions here. Millennials have one of the lowest average credit scores of any generation on record here. And there was a chart from Deutsche Bank who showed the average FICO score for both millennial and the younger generation Z is below 669, the level that defines subprime borrowers. So that's kind of interesting. So the fact that Gen Zers have effectively the same FICO score as millennials is quite troubling, suggests that there's more to the problem than merely the follies of youth. So again, Gen Zers are younger than millennials. If they have the same credit scores, what are millennials doing that are causing their scores to go down here? So Experian took a look at the data from the fourth quarter of 2018, which to take a look at what was going on with FICO scores. Very interesting. Basically, the millennials had an average FICO score of 665 in the fourth quarter of 2018, and compared to those 70 or older who had a 756. That's big time divergence there. Millennials have an average credit card balance of 5,200, up 7% from the year before. Millennials carried an average of almost 35,000 in student loan debt, up 8% from the year before. Millennials have an average total debt of almost $81,000, up 11% the previous year. So that's a situation. So we all know that when we talk about the millennial generation, as which for the past 5 years has been talked about as the savior of the housing industry and the economy. Well, you know what? Because of the sheer volume of them, we're not seeing that now because they can't buy anything. All right. So no offense if you're a millennial watching the video here, but this is just what comes down to what's going on in the economy here. So you've got lots of states where you have the highest and lowest FICO scores, but when I'm looking at Minnesota having the highest millennial FICO score out there, which is great, the average total debt balance is over $100,000. That's a lot of debt for a millennial. And that's not even including housing debt. Okay, so there you go. So that's interesting to see what's going on in the world, which it means harder to get cheaper mortgages, etc., and down payments. Home price growth slows, but rents keep rising as 2019 ends. So both home prices and rents continue to increase as the year reached an end. Home values increased in November, but the increase was the smallest annual growth since January 2013, according to Zillow. This is a Zillow report. Annual home growth has slowed in each of the past 19 months, Zillow noted, but the slowdown has been gradual. Out of the 35 largest metro areas, San Antonio and Washington, D.C. are the only ones to be growing at a faster annual rate than they were this time last year. Meanwhile, San Fran, San Jose, Las Vegas, and Seattle have slowed down the most, with San Jose and San Francisco seeing a decline in year-over-year home values. On the other hand, rent growth accelerated for the fifth straight month, up 2.3% annually to an average of $1,600. But for sale inventory fell 6.4%. In the end, across the board, inventory fell the most in Seattle, which is down 28.8%. So there you go. So the common trend this year in the housing inventory in housing was inventory shortage, now having reached the lowest level in Zillow data dating back to 2013. So there you go, guys. So we're seeing deceleration in prices from other sources here, which is interesting to note, but we're seeing an uptick in rent increases. So again, it's just where do you go? You got to go someplace you can't buy for various reasons. It's too expensive, can't get a mortgage, got lots of debt, don't want to pay the high prices, etc. You're going to go rent, and now rent is actually starting to pinch you. And I've got a oldest who's graduated now from university, and he has a new job a little bit south from where we are, starting to look for places for him. So we're going to experience this rental phenomena as well too. So I'll be able to comment on that as we firsthand go through that. Just some other notes here. This Christmas, over 500,000 Americans will struggle with homelessness, and the government estimates that ending homelessness would cost about $20 billion. That's actually less than Americans spend on Christmas decorations, but there appears to be little appetite to address this problem. So Department of Housing and Urban Development, HUD, basically says that on any any given day, there's around 553,000 Americans that are homeless. And a third of those are families with young children, which is not a good scene. Distressing numbers that we have here are actually probably underestimates because they don't include the many people who are sleeping in vehicles or other makeshift accommodation, right, like sleeping on friends' couches and things like that, called sofa surfing, etc. So, and also an experiment that was done in 2017 found that, the numbers are probably 1/3 to what they really are, because a lot of the homeless, don't want to be found, don't want to be talked to, and aren't visible and being seen, on the street all the time. So there you go. So just realize that that's what's happening now. And this, basically, the situation is, we're one of the richest countries, if not the richest country in the world. Yet we think that we should have our right to safe and a fundamental right of housing, but we don't, and we're one of the worst nations for that. This is the dichotomy of the housing market and the economy as a whole. Why this is a huge divergence in the wealth gap between the wealthy and the average income earner. So that's the scoop there. And again, we all know, because you can look at it every day in the news, certain locations across the country have worse homeless populations than others, and in some cases it's becoming epidemic to the whole point. It's big time and serious issues here. All right, last article for today, and before I mention that, hey, we're almost coming to a year end here in 2019, so if you want information about investing, I've got lots of fix and flip properties that are coming my way now. If you want to know about my advanced short sale training, I know some people have already jumped on it. We're going to have a great 2020 because this is where the inventory is and no one's touching. If you want more information on real estate, send me an email. Give me your contact information. I know I've responded to a lot of people, and we're trying to figure this out, hooking up and talk. So that's the scoop, guys. Reach out to me as soon as you can. I'll try to get back to you. The weekend's coming up. We got a few more days for the year end. I've got some great discounts happening on some of my products here and investing information, and it's going to get you going for the new year. All right. Last article right now: escaping Hong Kong residents purchase overseas homes as protest continues. So if you're looking at the news, and again, I make it a point to understand worldwide news and how it affects housing. Why? Because I'm just interested in it. I think it affects our marketplace, and also because I'm not from here originally. So I have a different perspective on other countries, etc. So there's been an increase in capital outflows from Hong Kong-based investors into other major global real estate markets, with Australia, Singapore, Japan, and the U.S. all seeing an increase in purchasing activity. Now, the reason is we've had some political turmoil in Hong Kong. A lot of people are going, you know what? I can cash out here now and get out. And Hong Kong has traditionally been one of the most, if not the most, one of the top one or two most expensive places to own real estate in the world, just because of the concentration on the island, the lack of space, etc. So people are starting to leave Hong Kong now. Typically it happens with political unrest or things that are changing, and they're bringing their money over. So unlike we've spoken over the past year, where we've seen a slowdown in Chinese investment money that's coming out, we're seeing an increase in stuff coming out of Hong Kong. And Hong Kong, is it China? Well, the British gave Hong Kong back to China, in 1987, I believe. It was a British Commonwealth under rule, and there's always been issues ever since that. I don't know what they are, but there's always been issues. I don't want to get into it right now, but the point is, it's starting to come to a head now, and the money's coming out. All right, so I would expect to see some locations on the West Coast, also Vancouver in Canada, get some Hong Kong buyers. They're trying to get their money out faster. I did read an article, which I didn't print out for today, but also we're seeing more Chinese money coming out, and it's secretly coming out. I mean, the Chinese government also put some controls and constraints on money leaving the country legitimately through the banks, but apparently there's a whole underground scene happening now. So don't be surprised if we see some changes in some of the local market, just because political unrest is causing people to get rid of their money out of the country. And of course, the best place to put it is going to be real estate. It's tangible fixed asset that at least, hopefully maintains, if not grows a little bit, maintains or doesn't lose that much money. But again, it's designed to get your money out and park it as opposed to a true investment here. So something to keep in mind. It's one of those things that, again, that's my whole point. Is it's this, Hong Kong is one of the priciest markets in the world. So the thought of maybe cashing out there and going someplace else it might make a lot of sense for a lot of people. So again, having said that, I really appreciate the views. I appreciate the likes and comments. Please share the video with your family and friends. Help my channel grow. Please click subscribe. If you'd like to talk about real estate or learn more about what we're doing, especially down here, there's a lot of activity going on. For whatever reason, when December came, things started to open up down here, which is interesting. So I've got a lot of stuff going on, a lot of properties that are off market that need to be moved. So if that's interesting to you, please drop me a line. If you want to also learn how to invest, as I said, in the one market niche that is not being pursued by virtually nobody out there, I call it the 1% rule, and I'm happy to explain that to you. Drop me a line, and we'll talk about that. So anyway, guys, take care, and we'll hopefully have one more video before the year end. Thanks.